AT&T has a market cap of $135 billion, a PE ratio of 8, and a dividend yield of 6% currently, with a stable business model and a customer retention ratio. So why does their stock chart look like this, and should we be buying these dips? Stick around to find out as we talking about that and more in today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. But with that being said, today we're going to analyze AT&T's business and Q2 earnings results. We'll do a deep dive into the financials, the top line, the bottom line, the balance sheet, especially now that they've spun off part of the business and lowered their mountainous pile of debt a little bit. And finally, we'll conclude with the valuation of this business using our intrinsic value calculator to see whether or not this is something we as retail investors should add to our portfolios or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. And as always, we'll be analyzing this business in 5 minutes and then using our calculator. So let's jump into it. So AT&T, the world's largest telecommunications company with the largest provider of mobile telephone services in the US. What are they focused on? Growing customer relationships, effective and efficient business practices, and deliberate capital allocation. Okay, in particular, we're going to see growth across their business segments. They're looking to save on about $4 billion of costs going forward. And then also we see here what they've done is they've actually received about $40 billion from the WBD stock that they spun off. And with those proceeds, they wanted to retire some debt and also provide an attractive dividend. All right, so again, focused on growth here, and we can see year over year, quarter over quarter, they have been growing, and they do have a relatively low churn rate, which is also pretty good and strong. And we can see the same thing across this fiber subscriber section as well of the business. In terms of the financial summary, we can see revenues standalone of AT&T have actually just slightly inched higher. Again, we have to take into consideration that a part of this business was actually recently just spun off. Earnings per share came in at about 65 cents, and on a year-over-year basis, free cash flow has shrunken a little bit, but we'll get back to that once we actually go through the statement of cash flows. For now, I just want you to remember this 65-cent figure in terms of earnings per share, as we'll be using that for our calculation later on. And we can see here that they have been growing just slowly though at 2% year over year for their standalone AT&T business. Now, in terms of the income statement here, we have about $24 billion in service revenue, $5 billion in equipment. So we get to that $29.6 billion figure. We deduct for our expenses and we're left with operating income about $5 billion. We deduct taxes, etc., and we come out with net income of $4.5 billion. And if we compare this with the results year over year, yeah, this is 2021, a lot of impairments, we had lockdowns, etc., and a bunch of other things that probably impacted the business's bottom line there. But what I really want to bring your attention to here is the balance sheet here. Okay, so we bring down our $4 billion of cash, which used to be $19 billion. So we can see that they've been doing some things with their cash. We'll get into that in just a second. But if we compare their current cash position to the current debt position that is owed within the next year, we can see it's at $6.2 billion currently. It was at $24 billion just 6 months ago. And what they've done is they've actually given a lot of their debt to the WBD spinoff. And then actually at the bottom here, you'll see their long-term debt. This is still quite high at $130 billion of debt, right? It was also at 156 months ago. They have also given some of that debt to WBD spinoff. So again, we compare the cash position of $4 billion to the debt position of, let's give it $136 billion. Things don't look too great. And yes, this is a concern for me when it comes to investing in a business like AT&T, because especially in the current economic situation we're in right now, where we're seeing rates are increasing and things. And since rates are increasing, we're going to see cost pressures on a bunch of things. And this might really hurt their business in terms of the large debt pile that they have on there if things are getting more and more expensive for them, right? Onto the statement of cash flows now, we can see they use a 6-month period. So they've added up their income from continuing operations. This is coming in at about $9.9 billion for the first 6 months of 2022. We add back in our depreciation, amortization, etc., and we're at about $15 billion of operating free cash flow, 15.4. Okay, we deduct our capital expenditures of $9.4 billion, and we're at about free cash flow ratio of about $6 billion. Now, what do they do with the $6 billion to reward shareholders? Remember, we also have to add in the fact that they have received about $40 billion in cash that they plan on using to shorten the debt pile. And yes, that's exactly what we see here. We can see that while they might have issued $2.5 billion of debt, they also paid down 15.6 billion here, 24 billion here, another 3 billion here basically, and then they also paid out a 5 to let's say $6 billion dividend as well. So if you were just looking at the statement of cash flows, this looks amazing because they returned about $50 billion worth to shareholders just in this quarter. However, we do know after reading the balance sheet that they do have about, still $130 billion of debt still laying there that they need to deal with, and they only have about $4 billion of cash. Now, what does their future cash flow situation look like? Well, they're actually decreasing their guidance on this, okay? So they're saying they were expecting about $16 billion, and now they're looking at about $14 billion. So they're saying by the end of the year, they will have $14 billion in free cash flow, and they're expecting another 10 to come from the second half of the year. So we just had about $6 billion, let's say, and they said that this was impacts of about $1 billion due to the timing of customer collections, other investments and costs and such. So based on this information, guys, let's jump into our calculator here to see where we would be comfortable picking up shares of AT&T at a margin of safety. All right, so if you saw on the last page there, they have expected about $2.50 in earnings per share for the year. So we'll input that into our calculator here with a 10% required return. They do pay a nice dividend actually. So we'll keep that in our calculation, and they're not growing at 40%. Don't worry, we'll change that in just a second. Let's bump this down to, they were growing, let's say at around 2%. So let's put this at 3. And then we'll say for the next few years after that, they can only grow at 1%. We're being really conservative here on the expected intrinsic value calculation with a 20 PE. Yeah, they could be valued at $43 per share, right? Now, if they can actually increase their growth like they say they can and grow up to 5% and then a consistent 3% for the 5 to 10 years after that, on a 25 PE, this stock could be up to 57. We're currently sitting at 18, let's say $19 per share. So this is significant upside. And in the very worst case scenario, let's say they can't grow for the next 10 years on a 15 PE, they should still be worth about $31 per share. Now this looks great so far, but what if AT&T starts to decline? Let's say in the worst case, they start to decrease their revenues and earnings by 3% for the first 5 years, and then a subsequent 3% for the next 5 years. They are still more than fairly valued for a 10% return. And if we take a look at the stock chart, we can see that just in 2020 alone, they were up to around $30 per share, which is about a 28% upside from this current levels, which we could figuratively see, assuming AT&T does improve on their financial side and they do begin to achieve higher rates of growth. Again, they do have a 6% dividend on top of that. So you're going to get some good value there from your investment if you were to think about AT&T. The only thing is the risk is the debt. There's huge pile of debt, and you have to see what happens if they're able to produce cash flows, if they're able to pay down that debt. Then AT&T might be an amazing investment, and that's something you're going to have to take into consideration if you like what you see from AT&T. But with that being said, that is the analysis for AT&T's stock and their Q2 earnings. If you've enjoyed the analysis, please leave a like, hit the subscribe button, and I'll see you on the next one.